Hi, welcome back. Paul Gerard from Price Accounting Services. Here today to talk about private health insurance, Medicare Levy Surcharge. Boring, I know, but expensive stuff. So just want to explain some of the tax issues surrounding this whole framework that helps seem to prop up our ailing medical system. First of all, Medicare Levy. Medicare Levy was introduced back in the Whitlam days, and Medicare Levy is the universal tax that is used to fund our hospitals and doctors. All taxpayers who are resident pay Medicare Levy if their income is above the threshold, which is in the 20,000 mark. There are some exceptions where they'll reduce it a little bit, and there are some exemptions for people who might be excluded because they have ministerial exemption, including people like soldiers and defence personnel. But generally speaking, every taxpayer will pay the Medicare levy, which is 2%, but rising soon in the next year or so to a higher rate. Okay, so it's up on its way up. Then we get into the realm of the so-called optional insurance, which is the private health insurance stroke Medicare Levy Surcharge area. And that's the one we really want to talk about because it's the one that can affect a lot of people, and it's probably going to apply to more and more people as we go forward. So how does it work? The government has set thresholds for individuals and thresholds for families. When we say family, we're talking the husband and wife, or the two partners, to be quite universal in our gender approach here. They don't need to be married, they don't need to be they can be same sex, doesn't matter, okay? The issue with private health insurance is this: if those two people earn more than the family threshold during the year, then it triggers the requirement that for every single day of the year they held an eligible policy with a private health insurer that covers the basic hospital that meets the mandatory requirements. And there's like an excess cap. You can't have an excess of $3,000, for example, on a policy. And if you're interested in further information about those sorts of policies, get onto one of the comparison websites, iSelect and the like, and they'll help compare the policies and their benefits, but I'm not here to talk about that. Medicare Levy Surcharge is triggered when the family income is higher and they haven't held the insurance for every day of the year. Now it's bizarre, at the moment, just approaching 30th of June, I'm seeing more and more TV ads with insurers telling you to rush out and get a policy. Well, I find it laughable that that's not how the system works. The system, that'll protect you for next year, it won't protect you for this year. You'll only have a few days of cover. So for example, let's say you are up for Medicare Levy Surcharge, which is an extra tax on top of your Medicare, again, that gives you no benefit whatsoever, but it's just like an additional tax. So you might as well get the insurance, get some cover, and maybe pay a little bit less tax. But if you went out today, let's say 20th of June, and you got your policy, you'd only be exempt from the Medicare Levy Surcharge for 10 days out of 365. So it's not a lot of great value, but next year you'd be covered for all 365 days. Medicare Levy Surcharge is a 2% additional tax, but it is also going up in the future. So have a look into it. If you're a higher income earner, as a guide for a family earning around 190,000, you could fall into the realm. Now, I say around 190,000. We can't just look at taxable income. Now, some people say, but I've got a rental property and it makes a loss. That helps me, doesn't it? The answer is no, it doesn't, because the adjusted taxable income that's used for these calculations excludes negative gearing losses and a few other things. So it more or less counts your salary that you earn, if you want to look at it that way. It's the same universal measure that's used by Centrelink for all benefit payments. So if your family income, more or less $190,000 or more, something you should be thinking about, maybe even getting your policy ASAP and addressing that. The other key issue with private health insurance is the tax offset. Now, what am I talking about? Okay. Years ago, the government said, we're going to pay 30% of everybody's private health insurance. Everybody's. And so you got a policy, you could pay a reduced premium and 30% was claimed by the health fund and the government paid it. Simple as that. A lot of people have never changed that, and they've come along and they've indexed and they've means tested. So now it's possible you're not entitled to anything whatsoever. So 0% entitlement, or it could be 10% or 20%. And then they've further indexed it down so that as premiums rise, your amount the government pays is remain fixed. So it's eroding the benefit that people are getting. It's really important when we do your tax return, 30th of June 2017, if we do it 6 months after the year, you're already 6 months into the next tax year, we can identify that you've overclaimed through your health fund. You'll have to pay that back. It'll be shown on your notice of assessment. So it's really important to, at some point around 30th of June, review your private health insurance. Make sure you haven't overpaid. And if you want to know whether you have or haven't, we can easily look at your 2016 notice of assessment and tell you if you were affected. And if you are, give us a call. Happy to help guide you. And we look forward to seeing you with another one of our videos on our YouTube channel, on our website, and look forward to seeing you then. Cheers.